Our aim in today's forum is to explore a number of issues critically important to all of us. Landmark financial reforms are in process globally. Banks face much tougher capital standards. And as part of all this, our industry is involved in a radical and fundamental reappraisal of how we manage risk. The reality, of course, is that we're entering a period of transformational change, a metamorphosis in the regulation and oversight of financial systems that hasn't been seen or experienced in almost 75 years. This transformation, driven and shaped by what we've learned from the financial crisis that peaked 2 years ago, also comes in the midst of the worst economic turmoil we've had in 3/4 of a century, with all of the problems that that brings. How did we get to this point? At this forum 2 years ago, I reported that during the depths of the market crisis and the period of unprecedented volatility and shaken confidence that followed, DTCC was able to sustain reliability and mitigate risk across the industry. In the wake of the Lehman collapse, we closed out more than $500 billion in open positions, and we prevented losses for the industry and perhaps ultimately for taxpayers that could have been in the hundreds of millions or billions of dollars. And we did all this without having to draw on any of the self-insurance funds you have on deposit with us. Many of you, in turn, told us of the quick actions you had taken and the sometimes painful decisions you had made to get your firms through the crisis. Together, our stories made a compelling tale about our collective success in fighting a number of dangerous fires. For people outside the financial industry, however, that wasn't the important part. They didn't, and they don't, care about what we had to do to put the fire out. They want to know why it got started in the first place, why it burned so fiercely, and why, as an industry, we hadn't taken preventive action. While each of us individually did our part to put out the flames, the prevailing view, as far as the public, their congressional representatives, and our regulators are concerned, is that the fire itself was the product of a shocking and fundamental failure of risk management and oversight in the markets we serve. And they continue to be very unhappy about it because they view our failure as having led not just to a financial crisis, but also to a harsh global recession, a staggering loss of jobs and wealth, and extreme damage to public finances in the developed nations as they bailed out failing financial institutions and sought to stabilize their economies. In fact, the loss of capital in financial assets worldwide as a result of the crisis has been estimated by some at well over $50 trillion. That amounts to the equivalent of 1 full year of GDP worldwide. In other words, it wiped out the value of all of the work done by all of the people in the entire world for a whole year. While the most difficult phase of the global financial crisis seems to have passed, and in China, the world's second largest economy, growth has hardly slowed at all, recovery in much of the rest of the world remains fragile. This year alone, an estimated 64 million more people worldwide will fall into extreme poverty, living on less than $1.25 a day due to the financial crisis. Meanwhile, the reverberations from the crisis continue to dominate the policymaking and regulatory environments around the world. If the fervor for financial reform can be measured by sheer volume, the Dodd-Frank bill that Congress approved 2 months ago is a good gauge. It runs to more than 2,300 pages. And since all those pages of legislative policy changes get translated into new rules and regulations, we face a daunting array of new requirements. More fallout from the crisis came out of Basel earlier this month, as regulators from 27 countries agreed to new standards requiring banks to increase their capital and risk reserves substantially. And we can all expect that these new rules will be enforced with vigor. Unavoidably, in the new post-crisis world, governments and regulators will understandably be focused on financial risk to a much greater extent than previously. To address these issues, we in the private sector will have to work with our regulators as partners rather than adversaries to improve our risk management operations. After all, at the end of the day, the relationship between regulator and financial enterprise is symbiotic. Regulators want the financial services companies they supervise to be healthy and safe. And they know that firms cannot be safe and sound unless they earn strong risk-adjusted returns. In fact, regulators for generations have utilized rating systems that have included earnings, along with other important factors such as capital and liquidity, as a key metric of the health of a financial services firm. We at DTCC understand that the bar of regulatory expectations on risk has been raised, and what used to be normal or standard operating procedure is fast becoming history. As a result, we are now initiating a top-to-bottom transformation in how DTCC thinks about risk, how we oversee risk, how we manage risk, and how we plan to address risk. And I mean all aspects of risk, both within DTCC and within the financial system we are a key part of. This is a sweeping, all-hands-on-deck initiative that comes at the direction of our board. In effect, we're setting off on a voyage that will take us to the edge of the map and perhaps beyond the map entirely. Those of you who were here last year may recall that I talked about ancient maps and the expression, "there be dragons," that often appears in the corners of many of them. "There be dragons" was a medieval mapmaker's way of saying they had no idea what was out there at the edge of the world, but it was unquestionably dangerous. Well, there's no navigational map for any of us in this new risk environment. And on the journey, we'll probably run into some dragons in the form of tough and very complex risk management issues. This journey will be an extremely ambitious undertaking that forces DTCC to rethink many of the assumptions behind the practices we've employed and the services we've been offering our participants for decades. In other words, it will alter, in some ways significantly, how we support and work with you to further mitigate risk. We are firm in our understanding of this new responsibility. We are clear that our regulators and supervisors view it as imperative that we address this new responsibility. And we also received a very similar message from many of you earlier this year when we polled our member firms about our strategic direction and our strategic planning. The principal message that came back to us from those interviews with you was to keep focused on our core services, and above all else, to ensure risk mitigation. And our board has emphatically reinforced this message, telling us that we need to make a quantum leap in the level and scope of risk mitigation we provide all across the industry. One example that I've used internally at DTCC to explain this new perspective comes from an economist who has become quite popular in the last few years, as his theories cast an interesting light on the financial crisis. You may have heard of Hyman Minsky, an economist who specialized in the economics of financial systems. Minsky's key perception was recently summarized as stability itself is destabilizing. That is, that the financial system over time has an inbuilt bias towards instability and crisis. As the financial system becomes confident about stability, we're in good times with minimal losses on financial investments and credit decisions. People naturally relax, and for competitive reasons and others, begin to make the closer calls, to make credit and investment decisions that are nearer to the margin. The level of risk in the system begins inexorably to rise. Minsky set out a very structured way of understanding how this unfolds. Initially, credit decisions require a demonstration of ability to repay both principal and interest. But as we begin to relax, they shift over time towards loans with more balloon-like structures, dependent on the borrower's ability to refinance to pay the principal. And then, as the boom really reaches its peak, towards loans that depend on continued improvement in economic conditions to be repayable at all, what Minsky referred to as Ponzi finance. At some point, the music stops, we reach what has now become known as a Minsky moment, and the process goes into reverse. Loans fail, collateral must be liquidated, the process of collateral liquidation itself causes more loans to fail, etc., and repeat indefinitely as the strength of a financial hurricane whips up through Category 3 to Category 4 and beyond. Does any of this sound somewhat familiar? Internally, we've used Minsky's theories and other similar views to help our staff understand the challenge of renewal we face at DTCC. As a core industry infrastructure, we must understand and act on Minsky's central insight, that stability itself is destabilizing, and that our very success at identifying and managing risk brews a propensity in the financial system to generate more risk through the creation of more demanding investment instruments, more complex trading programs, or in other forms of risk. And we must be vigilant as that propensity unfolds to identify those new forms of risk and extend our capabilities and understanding to address them effectively. And then, again, repeat that process as that new success in risk mitigation engenders still newer forms of risk-taking. We've also used internally the example of the evolution of our business continuity capabilities after 9/11. In that event, DTCC realized, as we all did, that as good as our business continuity planning had been, it was going to have to be transformed. We could no longer focus primarily on surviving natural disasters or assume that the problem to be solved was our inability to operate. We had to recognize that we were responsible for safeguarding against events that caused the system to become temporarily inoperable. We realized that we had to begin planning to protect ourselves and the industry we serve against the unthinkable and the unimaginable. And truthfully, we and the industry have done a spectacular job of responding to that transformed understanding of BCP.